Every day, millions of traders stare at their screens, tweaking indicators, adding confirmation rules, and watching endless guru videos, all promising the elusive setup that works. They chase the perfect strategy, believing that success lies in a complex algorithm or a secret pattern. But what if the problem isn't your setup at all? What if you keep sabotaging your own trades, not because of a flawed strategy, but because your system was never built for you in the first place? Let that sink in. The financial markets are a battlefield, but the real war isn't against the algorithms, the news, or the shadowy forces of institutional trading. The real war begins within you, in the subtle whispers of your nervous system, in the unspoken expectations that dictate your every click. This isn't just about intelligence, it's about emotional dissonance. It's about trying to scalp the market with the measured, deliberate mind of a chess player, or attempting to run 15-second charts when your very being craves calm and contemplation. You're following what worked for someone else, someone whose psychology is fundamentally different from your own. And that, my friend, is why 80% of traders quit within 2 years. That's why even the most profitable systems collapse under pressure. That's why your hands tremble before an entry, even with a 70% backtest. Because this game isn't about who has the best strategy. It's about who can consistently execute under stress. And that requires more than just an edge. It requires a profound, undeniable fit. Welcome to the psychological deep dive into trading, where we uncover the hidden forces that truly drive your success or failure. This isn't just another tutorial. It's a mirror, reflecting the truth about your trading journey. Chapter 1. The real reason trading systems fail. Most traders are convinced that the adversary hides outside their trading desk. The unpredictable market, the manipulating algorithms, the abrupt news events that send prices plummeting. They believe that if they could only conquer external elements, if they could just locate that one perfect indication or that infallible arrangement, then steady profitability would be theirs. But this is a dangerous illusion. The true conflict, the one that determines your final success or failure, begins long before the chart even loads. It starts in the silent moments before you place a trade, in the tiny adjustments of your body, the rhythm of your breath, and the weight of your expectations. You observe a clean setup, a properly formed RSI divergence, a textbook entry. Yet in that key moment, you pause, or worse, you click too quickly, propelled by an impulse you can't quite describe. Then you watch, heart beating as red candles inexorably devour your entry, converting a good opportunity into a devastating loss. You knew better. You arranged it meticulously. But when it meant most, you cracked. Consider Tudor Jones, one of the best macro traders in history. In his pivotal interview for the Market Wizards series, he disclosed a truth that most aspiring traders simply overlook. He doesn't hold to a single rigid system throughout his career. Instead, he adjusts. He adapts his technique dependent on his current life stage, his energy levels, even his family situation. When he was young and carefree, he'd trade all night, riding every tick, motivated by an insatiable yearning for the market's pulse. Now, with a family and various responsibilities, his trading structure has evolved considerably. The information stays the same, but its application has evolved. This isn't a sign of weakness. It's a testament to profound self-awareness. The fact that persistently destroys most traders is this: Systems fail not because they are intrinsically flawed, but because they are wearing the wrong trader. It's like trying to sprint a marathon in shoes 2 sizes too small. You can force it for a little, terrible moment, but eventually something breaks. That's not strategy failure. That's a fundamental system mismatch. This pattern exploded into public knowledge on Reddit last year. A user, Throwaway to Trader 2023, offered a raw, honest experience of squandering 3 funded accounts by blindly replicating complicated ICT inner circle trader tactics. His post went viral on the r/aj day trading subreddit. I realized I was trying to be a sniper when I'm really a chess player, he wrote. Switched to daily time frames and haven't had a red month since. The thread received over 1,400 replies, a torrent of hundreds describing similar, terrible wake-up calls. One reply from a risk manager called Sarah resonated deeply. I'm a mom of 2. Tried scalping the London session at 3:00 a.m. Nearly destroyed my marriage and account. Now I trade weekly options during nap time. Same information, different application. Finally profitable because I'm finally being myself. This isn't an outlier. A systematic research published in the Journal of Behavioral Finance explored the various reasons why retail traders continually fail. The alarming finding, 73% of consistent losses originated from what they labeled strategy-personality mismatch. It wasn't inadequate risk management or terrible entries or a lack of technical skill. It was merely employing methods that fundamentally broke their psychological wiring. Let me paint this vision differently. Imagine you are a naturally introverted individual, someone who needs calm, uninterrupted space to think clearly and assimilate information. Yet, you push yourself to trade in a loud, bustling co-working space because some guru preached the idea of community. Every single exchange becomes an internal conflict, a war against your own nature, not because you lack competence, but because your environment fundamentally opposes your basic desires. Or perhaps you're someone who needs to see the big picture, to appreciate the larger context and narrative of the market. But you find yourself looking at 1-minute charts, urgently trying to catch every micro move, simply because that's what's popular on YouTube. Your brain, very literally, cannot process information adequately in this fashion. When your trading system, your environment, or your chosen time frame violates your nature, it creates an invisible, insidious friction. Decision weariness builds like compound interest, increasing silently. Micro failures mount up, one after another. Self-doubt intensifies, rising louder with each misstep. Soon, even textbook situations, the ones that should be simple and obvious, begin to feel like intricate traps. Here's the formula that most educators, most mentors, most trading classes absolutely miss. Edge equals setup plus psychology plus execution alignment. If any single portion of this vital equation breaks down, the entire system falls. That's why blindly imitating someone else's precise method is equivalent to wearing their prescription spectacles. Sure, you might be able to see something, a vague shape, but it's never fully clear. It's never comfortable. And ultimately, you'll have a big, throbbing headache. So, let me ask you a question, one that might profoundly impact your entire trading journey. Have you ever ran a system that looked perfectly wonderful on paper, that promised regular returns, but made you dread opening your trading platform? Not just nervous, but true gut-wrenching dread. If your response is yes, then you've experienced the tremendous impact of system mismatch. Recognizing this pattern, acknowledging this internal conflict, is the essential first step to breaking free from its control. What if you never actually lacked discipline, but rather you lacked alignment? What if your best, most profitable trading self is currently concealed, crushed by the weight of the wrong system? If that's true, then the following issue becomes obvious. If your present system doesn't fit, how do you construct one that does? Chapter 2. Profiling. Know yourself first. Before you can think about establishing a trading system, you need to construct a mirror. Not a mirror for the market, but a mirror for you. Because every truly effective system, every technique that consistently creates profit, is a direct mirror of who you are. Your anxieties, your strengths, your blind spots, your natural rhythm. Skip this important step, and you're attempting to assemble with mismatched parts. It might run temporarily under great pressure, but inevitably it will either break down or worse, break you. Linda Raschke, a great floor trader from the 1980s, learned this lesson the hard way. She thrived on the raw, chaotic energy of the trade pit. When electronic trading came, she didn't just shift platforms. She had to radically reinvent her entire strategy. In an interview with Better System Trader, she famously declared, "I had to learn to trade like me, not like the person I was trying to become." The market doesn't care about your objectives. It responds to who you genuinely are. So, how can you genuinely figure out who you are as a trader? Not through personality tests, or God forbid, astrology. Though if Mercury retrograde is your go-to excuse for shopping clothes, we really need to chat. I'm talking about knowing the unique, trade-relevant features that characterize how you respond under the unrelenting strain of risk, uncertainty, and time. Through analyzing hundreds of consistently profitable traders, from Frank Reddit AMAs to in-depth prop firm interviews, 4 crucial traits regularly emerge. Understanding this will be your first step towards developing your personal mirror. First, tempo preference. This isn't only about choosing a time frame. It's about your natural rhythm of decision-making. Some traders innately need time to process, to evaluate, to weigh every perspective before acting. They are the chess players, deliberate and meticulous. Others thrive on immediate pattern identification and lightning-fast execution. They are the snipers, reacting instantly to ephemeral opportunities. Tom Huggard, who famously turned $10,000 into millions, discusses extensively about this in his book. He's naturally high-tempo. He tried position trading since it looked smarter, more sophisticated, but he failed spectacularly. Only when he returned to day trading did he find his genuine edge. "I need to feel the market's pulse in real time," he explained. "Daily charts feel like watching paint dry." Contrast this with Investor Dean on Twitter, who takes maybe 2 trades a month. He once revealed his results, boasting a 74% victory record over 18 months. His philosophy? "I'm not inactive, I'm selective. My edge is patience." Forcing himself to trade regularly would entirely demolish that edge. Second, energy flow. When is your brain genuinely online? This seems deceptively simple, but it is career-defining. A study of prop traders indicated that success might vary by up to 40% based on whether they traded during their peak versus off-peak personal hours. I know a trader, let's call him Alex, who forced himself to trade the London Open at 4 o'clock a.m. California time. He consistently lost money. The moment he switched to the New York afternoon session, following the exact identical method, his performance improved by 40%. His brain simply wasn't functional at 4 o'clock a.m. No amount of coffee could repair that basic incompatibility. Third, decision style. Are you a gut trader, relying on intuition and feel? Or are you a checklist guy, demanding objective rules and confirmations? Do visual patterns speak to you, or do you want numerical data to make sense of the chaos? This isn't about whether style is greater. It's about which one matches your specific cognitive wiring. Crypto Garlic on Twitter is pure intuition. He posts charts with simply price activity, no indicators. The chart tells me everything, he asserts. Indicators just add noise. Meanwhile, Quantu95 won't take a deal without 3 unique indicator confirmations. I need objective signals, he insists. Discretion is where I blow up. Fourth, emotional trigger map. This is likely the most significant dimension. What is your kryptonite? Everyone, without exception, has distinct emotional vulnerabilities that continuously damage their trading. Common trends discovered across thousands of traders include FOMO types, can't stand missing moves; revenge traders, one loss initiates a destructive spiral; perfectionists, overtrade trying to perfect every entry; and freezers, analysis paralysis at vital moments. Identifying your principal trigger is like knowing you're allergic to something. You can't eradicate the weakness totally, but you can create effective protections around it. Let me provide you a realistic framework to identify your type. For the following 3 trades you take, document how long it takes between seeing a setup and actually taking action. What made you eventually click? How did waiting feel physically? What thoughts race through your head? Patterns will emerge with amazing quickness. One trader noticed she only took successful transactions when she acted within 30 seconds of seeing them. If she waited longer, doubt crept in, and she'd either skip the deal or enter badly. She devised a basic time system, and her findings were altered. The market viciously punishes merchants who pretend to be someone else. Try being a patient swing trader when you're wired for continual activity, and you'll surely overtrade out of pure boredom. Try scalping when you need adequate time to ponder, and you'll freeze at enters or panic exit winnings. So, here's your first assignment. Over the following 24 hours, simply notice when you feel most attentive, most clear, most determined. Not when you think you should trade, but when your brain truly functions best. Then, examine what types of decisions feel natural versus those that feel forced. Type discovering in the comments if you're ready to quit forcing and start flowing. Share one thing you've noticed about your natural trading habits. Sometimes, witnessing others claim their own style gives us permission to express ours. Because if you fully know who you are, developing the appropriate system becomes not just obvious, but unavoidable. Chapter 3. The Architecture of Alignment. Now that you're beginning to understand yourself, your innate biases, and your natural rhythms, it's time to construct your system's architecture around that newfound insight. This is where most traders make their first and often deadly mistake. They dive into a strategy based only on its apparent profit potential, or because some guru is boasting its great returns, completely ignoring the important issue of psychological congruence. But you are not here to chase someone else's edge. You are here to construct an edge that belongs uniquely to you, one that connects with your deepest self. System architecture, in this context, comprises three interconnected pillars: market, time frame, and style. These are not only tactical choices, they are profound psychological design elements, much like picking the correct materials to build a house. Pick the incorrect ones, and the entire edifice will eventually collapse under emotional weight, regardless of how sound the initial layout seemed. Let me demonstrate what this looks like through the stories of real traders who got it right and those who got it tragically wrong. Market selection is about rhythm, not just opportunity. Each market has a distinct personality, a unique pulse. Cryptocurrency markets trade 24/7, giving extreme volatility and a tribal, almost cult-like atmosphere. Forex markets follow global sessions, defined by deeper liquidity and macroeconomic rationale. Stock markets have opening bells, closing bells, and weekend breaks, giving regulated pauses. Your aim is to locate a market whose personality fits yours. Take Max, a crypto trader who blogged about burning out after just 2 years. "I thought crypto was perfect because it never sleeps," he wrote. Turns out that was the problem. I never slept either. He turned to Forex, trading only during the London and New York sessions. 6 months later, he posted again, reporting sustainable profitability. Same technical skills, different market, finally sustainable. Sleep is my edge now. Or consider Sarah Thompson, highlighted on a leading broker's trader spotlight. She started in Forex since it appeared professional but battled for 3 years. She subsequently shifted to small-cap stocks. "I need stories, not just charts," she emphasized. "Every stock has a narrative. Forex felt like trading math. Stocks feel like trading businesses." Her returns doubled within a year of switching. The lesson is clear. Your market rhythm must match your life rhythm. If you have kids, need structure, or work a day job, a 24/7 Bitcoin market can ruin you. If you seek continual action and have a flexible schedule, the more organized Forex sessions could feel restricting. Time period is where traders truly sabotage themselves. Your chosen time frame doesn't simply define trading frequency. It dictates your emotional frequency. It determines how often you are exposed to decision-making, stress, drawdown pain, and profit temptation. Here's what most traders fail to understand. Each time frame bears a unique psychological cost. 1-minute charts demand continual attention, split-second decisions, and a very high stress tolerance. Daily charts, contrary, require great patience, steadfast conviction, and the capacity to sit through multi-day drawdowns without flinching. Neither is fundamentally harder. They are simply different sorts of hard. Jeremy, from Real Life Trading, portrayed this wonderfully in a video. "When I switched from 5-minute to hourly charts, my accuracy improved by 30%, he claimed. "Not because hourly is better, but because I think better with time to process. Those extra 55 minutes between candles, that's where my edge lives." An intriguing research from a prop business tracked traders forced to alter time frames. Day traders shifted to swing trading showed an initial 40% performance reduction, then a 60% improvement following adaptation. Swing traders went to day trading, however, and 70% never recovered their edge. The difference? It's substantially easier to slow down psychologically than it is to hurry up. Strategy style is the final critical aspect. Are you a momentum rider, chasing explosive moves? A mean reversion player, capitalizing on extremes? Or a breakout hunter, looking for clear signals? This isn't about which style prints the most money. It's about which one fits your psychological profile. Momentum trading suits traders who desire activity, fast feedback, and excitement. Think Tom Huggard or Ross Cameron. They thrive off energy, riding waves. Mean reversion suits analytical types who sense value in extremes, patiently waiting for the market to adjust itself. Breakout trading matches people who seek clear signals and established risk parameters. The mismatch here can be terrible. I once observed a careful, analytical trader try to become a momentum scalper because his mentor traded that way. 6 months later, he remarked on Elite Trader, "I've become someone I don't recognize. Anxious, impulsive, continuously stressed. This isn't trading, it's torture." Your system architecture must assist your life, not dominate it. A single parent cannot reasonably monitor 5-minute charts all day. A full-time staffer cannot catch every London breakout. A naturally cautious individual should not drive themselves into high-frequency momentum bets. So, here's how you choose. For market, if you require structure, choose equities or session-based Forex. If you seek flexibility and constant action, crypto or futures might be your suit. If you need stories and narratives, individual stocks are great. If you prefer pure price activity, indices, or Forex. For time frame, if you're a quick thinker, 1 to 15-minute charts. If you require processing time, 1 to 4-hour charts. If you're a big picture thinker, daily or weekly charts. If you detest waiting, lower time frames. If you detest rushing, greater time frames. For style, if you adore energy, motion. If you see value, mean reversion. If you require clarity, trend following. If you adjust easily, multi-strategy. The correct combination exists for your psychology. Finding it isn't optimization, it's alignment. Share your dream architecture below. Forex plus 4-hour plus mean reversion or whatever resonates. You'll be shocked how many successful traders have your same preference. That's not coincidence. That's psychology. Chapter 4. Entry Logic, where mind meets market. Most traders operate under the false assumption that they lose money because their entry is wrong. They obsess over precise candlestick patterns, Fibonacci levels, and indicator crossovers, believing that the perfect entry will guarantee success. But the truth is far more nuanced. Traders often lose not because their technical entry is flawed, but because their decision-making process is fundamentally misaligned with how their brain handles stress. You can memorize every chart pattern in existence. You can backtest 1,000 strategies to perfection, but when your fingers hover over the mouse and that insidious hesitation creeps in, that's not your strategy failing. That's your mind, your nervous system, rejecting the complexity, the uncertainty, the emotional weight you've forced upon it. Entry logic, therefore, isn't just technical, it's a cognitive interface. It's your primary point of contact with the inherent chaos of the market, and its ultimate purpose should be to bring calm, not confusion. It should be a process that allows you to execute your edge without internal resistance. Let me tell you about two traders who perfectly illustrate this distinction. First, consider Rosa, who shared her transformative journey on Forex Factory. She had a technically sound price action strategy, but she struggled with execution. Her entries were often late, or she'd miss them entirely, paralyzed by doubt. She realized her problem wasn't identifying the setup, it was the mental friction between seeing the setup and pulling the trigger. Her solution was to simplify her entry criteria to an almost absurd degree, focusing on only one or two high-probability patterns that she could identify instantly, without conscious thought. She also implemented a pre-trade ritual. Before every entry, she would take 3 deep breaths and verbally state her exact entry conditions and risk. This ritual, this cognitive interface, transformed her trading. It wasn't about finding a better technical entry, it was about creating an entry process that her mind could execute without resistance. Then there's David, a prop firm trader who initially struggled with overthinking his entries. He had a tendency to add more and more confirmation filters, believing that more data would lead to better decisions. Instead, it led to analysis paralysis and missed opportunities. His mentor challenged him to trade for a week using only one simple entry rule, regardless of other factors. David was terrified, but he committed. To his surprise, his execution improved dramatically, and his profitability, while not perfect, became more consistent. He realized that the mental energy he was expending on complex entry confirmations was draining his ability to execute cleanly. His mind was constantly battling itself, creating internal friction. By simplifying his entry logic, he reduced the cognitive load, allowing his brain to operate more efficiently under pressure. His entry system became a conduit for calm, not a source of confusion. The lesson here is profound. Your entry system should be so clear, so intuitive, so aligned with your natural decision-making style that it feels almost automatic. It should reduce the number of variables your brain has to process in the heat of the moment. If your entry logic requires you to perform complex mental gymnastics, to second-guess yourself, or to battle internal resistance, it's not a good fit for your nervous system. It's a recipe for hesitation, missed trades, and emotional frustration. The goal is to build an entry system that you can execute with conviction even when the market is screaming at you. It's about creating a clear, well-worn path from recognition to action, minimizing the psychological friction that so often derails even the most promising strategies. Your entry is not just about where you get in. It's about how you get in, and whether that process supports your psychological well-being under pressure. It's the moment your mind meets the market, and that meeting should be one of calm, confident execution, not internal conflict. Chapter 5. Risk Management, the Psychology of Protection. In the world of trading, risk management is often presented as a purely mathematical exercise. Position sizing, stop-loss placement, calculating R multiples. While these technical aspects are undeniably crucial, they represent only one side of the coin. The deeper, more impactful dimension of risk management lies in its psychology, specifically in understanding your own emotional maximum for risk. Most traders focus on how much they can risk, not how much they can emotionally bear to risk. This distinction is paramount for the market will relentlessly test the limits of your psychological tolerance. The danger of over-risking extends far beyond the immediate financial loss. It's the emotional fallout that truly devastates a trader's journey. When you risk more than your nervous system can comfortably handle, every price fluctuation becomes a gut-wrenching ordeal. A small drawdown feels like a catastrophic collapse. The fear of loss becomes so overwhelming that it paralyzes your decision-making, leading to premature exits on winning trades and stubborn clinging to losing ones. This is why the adage, "excitement is expensive, boring is profitable," holds such profound truth in trading. When you are constantly seeking the thrill of a big win, when every trade feels like a high-stakes gamble, you are operating from a place of emotional volatility, not calculated probability. This emotional roller coaster is unsustainable and ultimately unprofitable. The goal of psychological risk management is not to eliminate risk. That's impossible in trading, but to manage it in such a way that trading becomes, dare I say, boring. Boring is the pathway to consistent profitability. When your risk per trade is aligned with your emotional capacity, you can execute your plan without resistance. You can watch a drawdown unfold without your hands trembling because you know deep down that this is a manageable part of the process. I know funded traders who consistently make six figures risking a mere 0.5% of their capital per trade. Not because they lack confidence, but because they have found their emotional sweet spot and committed to staying there. They understand that the objective isn't to handle more risk. It's to handle their risk so well that trading transforms from a stressful gamble into a systematic, almost mundane activity. So I challenge you, what is your real comfortable risk? Not what you think sounds good, not what some guru preaches, but what actually feels manageable to your nervous system. This number might surprise you. It might even feel embarrassingly small. But embracing this reality is the first step towards sustainable trading. Remember, the market doesn't care about your ego. It cares about your behavior. And your behavior is inextricably linked to your emotional state. By aligning your risk management with your psychological capacity, you build a foundation of calm and consistency, allowing your edge to manifest without the constant interference of fear and greed. This is the true psychology of protection, safeguarding not just your capital, but your mental well-being and your longevity in the markets. Chapter 6. The Guardrails That Save Accounts. Let's be uncomfortably honest for a moment. Most traders don't need more strategy. They don't need another indicator, another complex setup, or another guru's secret formula. What they desperately need is protection from themselves. Because the most dangerous moment in trading isn't when your setup fails, it's when you fail to follow your setup. And that failure rarely stems from ignorance. It happens from a profound lack of guardrails, from an over-reliance on willpower in the face of overwhelming emotional impulses. A trader on Elite Trader once posted something that haunted me. I know exactly what I'm supposed to do. I've proven my edge, but sometimes I become someone else. Like I'm watching myself destroy my account from outside my body. I need help. The thread exploded, with hundreds of traders relating to this out-of-body, self-destructive experience. The solution that emerged from that discussion wasn't about discipline. It was about building systems that assume you will lose control and catch you before you hit the ground. Dr. Brett Steenbarger, a renowned trading psychologist, has researched this phenomenon extensively. His core insight: the best traders aren't necessarily the most disciplined. They are, in fact, the most prepared for their own weaknesses. They build systems, processes, and external controls that protect them from their predictable failures. Let me show you what effective guardrails look like through real-world examples that transcend mere willpower. Consider Mechanical Mike, a crypto trader who shared his ingenious solution. After 2 losses, my platform locks me out for 2 hours. Not optional. It's coded directly into my execution platform. This simple, non-negotiable lockout saved him from every revenge spiral for 2 years. He posted his equity curve, a smooth upward trajectory with no massive drawdowns. The lockout wasn't a punishment, it was his edge. Then there's Sarah, a Forex trader who partnered with another trader. "We have each other's broker passwords," she revealed. "If either of us tilts, the other changes the password." Sounds extreme? My account's up 400% since we started. His too. This is external enforcement at its finest. Professional trader Lance Breitstein uses a physical circuit breaker. "I can only click buy when the timer's green. After any trade, it goes red for 15 minutes. This forces him to step away, breathe, and reset, completely eliminating his tendency to overtrade. And in a fascinating, tech-savvy approach, one trader shared his biometric monitor setup. "If my heart rate exceeds 100 BPM, my platform won't let me trade. Stress literally locks me out." These aren't signs of weakness. They are profound acknowledgments of human fallibility. The market is expertly designed to trigger your worst impulses. Fighting that with willpower alone is like trying to hold your breath underwater indefinitely. Eventually, biology wins. The most effective guardrails share common features: automatic activation, no willpower required; immediate implementation, no delay; external enforcement, can't self-override; and specific triggers, clear conditions for activation. Let's delve deeper into the psychology. Why do smart people need dumb rules? Because intelligence and emotion operate in different brain regions. When your amygdala, the emotional center, fires up, your prefrontal cortex, the rational, decision-making part, goes offline. You literally become temporarily stupid. Guardrails work because they are decided by smart you and implemented automatically, protecting you from stupid you. A Reddit user studying trading psychology observed this firsthand. "I recorded myself during trading. Calm me and tilted me are literally different people. Different voice tone, posture, even vocabulary. Guardrails are calm me, protecting myself from tilted me." Here are some of the most effective guardrails I've seen. The pre-trade checklist. Before entering any trade, you must complete a written checklist, not mental, written. Include: is this my A+ setup? Am I following my plan? What's my emotional state? 1 on 10. Would I take this trade if I was up, down 5%? If any answer is negative, no trade. Period. The time boundary: trade only during predetermined hours. Outside those times, your platform is closed. No exceptions. No just checking. One trader reported, "Limiting myself to 9:30 to 11:30 a.m. only doubled my profitability. Less time, better trades." The loss limit ladder. 1 loss, continue normally. 2 losses, reduce size by 50%. 3 losses, stop for the day. Weekly limit, 5 losses maximum. This prevents both daily spirals and weekly account destruction. The cooling off protocol. After any rule break, a mandatory 24-hour trading break, plus a written analysis of what happened. This isn't punishment, it's pattern recognition. I noticed I only break rules after arguing with my spouse. Now, I don't trade on those days. The success limiter. This one's counterintuitive. After 3 winning trades, stop for the day. Why? Overconfidence kills more accounts than losses. One trader shared, "My biggest loss has always followed my best days. Now I bank wins and walk away." Implementation is everything. Start with just one guardrail, master it for 30 days, then consider adding another. Trying to install too many at once ensures none will stick. A former gambling addict turned profitable trader once said something profound. Addicts need external controls until internal ones develop. Trading's the same. Guardrails aren't forever. They're there until you don't need them. But thinking you don't need them before you're ready, that's the addiction talking. So here's your challenge. What's your biggest account killer? Revenge trading? Overtrading? Breaking stops? Pick one guardrail from above that directly addresses it. Implement it tomorrow. Not next week, tomorrow. Share your commitment below. Your future self will thank you. Remember, the market will always test your weaknesses. Guardrails ensure you pass the test. Chapter 7. Forward Testing, the Bridge to Reality. There's a dangerous chasm that every aspiring trader must cross. The gap between backtest beauty and live market brutality. Your system, meticulously crafted and backtested, shows a perfect equity curve, a flawless historical performance. But now, the market breathes. Candles form in real time. Your palms sweat. Your logic evaporates. This is where most systems, regardless of their theoretical edge, die. Not because they are fundamentally flawed, but because they have never been psychologically stress-tested. A prop firm trainer once shared a profound insight. We don't care about backtest results anymore. We care about forward test behavior. How does the trader act when real patterns form? That tells us everything. Forward testing, therefore, isn't primarily about proving your system works. It's about proving that you can work your system. There is a massive, often overlooked difference. Let me share what happened with Elena, a talented trader from TradingView's featured list. She built a gold future system, backtested it for 5 years, boasting a 62% win rate and a healthy 1.0 average winner with a beautifully smooth equity curve. Confident, she started trading it live. The result? Disaster. She closed winners prematurely at 0.5 R, held on to losers far past her defined stops, and missed entries entirely due to hesitation. "My system was fine," she posted, distraught. "I was broken. The backtest never tested me." So Elena devised what she called psychological forward testing. For 30 days, she traded her system on a demo account with one ironclad rule. Treat it exactly like real money. Same routines, same emotional commitment, same everything. But she added a crucial layer: psychological tracking. For each trade, she logged her confidence level before entry, 110. Her anxiety during the trade, 110. Her urge to interfere, 110, and her actual behavior versus her planned behavior. The patterns that emerged shocked her. Every time a trade went 70% towards her target, her anxiety spiked to 810, and she'd close early every single time. Her solution was brilliant. After entering any trade, she would close her platform and set an alert for her target. Then, she would immediately journal about the trade as if it had already hit its target. This presumption of success, this act of pre-framing, began to rewire her psychology. When she returned to live trading, the early exit problem had vanished. This is the immense power of proper forward testing. It reveals not just if your system works, but how you work within your system. The most effective forward testing protocol I've seen comes from SMB Capital, a renowned proprietary trading firm. They require all new traders to complete the gauntlet. Weeks 1 to 2, trade the system exactly as designed on a simulator. Track only adherence, not profit. Weeks 3 to 4, add psychological pressure. They literally have someone stand behind the trader, randomly saying things like, "That's a lot of red," or "Shouldn't you take profit?" It sounds silly, but traders who can't handle fake pressure certainly can't handle real pressure. Weeks 5 to 6, trade with real money, but tiny size. The goal isn't profit, it's maintaining the exact same behavior as on the simulator. Weeks 7 to 8, gradually increase size while meticulously monitoring behavioral changes. Only traders who demonstrate consistent psychology across all phases get funded. The failure rate? A staggering 85%. Not from bad trading, but from psychological inconsistency. Here's what most traders get wrong about forward testing. They focus on results instead of process. A losing forward test with perfect execution is a successful forward test. A profitable forward test with rule breaks is a failure. You're not testing the system, you're training your nervous system. An ICT trader documented his forward testing journey, posting every trade for 100 trades straight. The transparency was brutal. You could see his psychology evolve in real time. Early trades showed classic errors: moving stops, adding to losers, closing winners early. By trade 50, his behavior stabilized. By trade 100, his execution was robotic. His advice? Forward test until you're bored. Excitement means you're not ready. When trading your edge feels like brushing your teeth, that's when you're ready for real money. The psychological milestones that truly matter are: can you take 5 losses straight without changing anything? Can you hold a winner to target when it pulls back 50%? Can you skip a setup that's almost valid? Can you stop trading after hitting your daily target? Can you trade exactly the same whether you're up or down? Until these behaviors are automatic, you are not ready for significant capital. Period. A brilliant framework from the Trading Framework podcast suggests treating forward testing like athletic training. Athletes don't go from practice to championship. They have exhibition games, scrimmages, increasing competition levels. Trading needs the same progression. Level 1, simulator with no pressure. Level 2, simulator with self-imposed pressure. Level 3, small, real money. Level 4, normal position size. Level 5, scaling up. Skipping levels is like a runner going from the couch to a marathon. Injury is guaranteed. One critical insight: forward testing reveals system flaws that back testing misses. Not technical flaws, but execution flaws. Perhaps your entry requires too many confirmations to catch in real time. Perhaps your stops are mathematically correct, but emotionally unbearable. These only show up when you're clicking real buttons with real money on the line. So here's your assignment. Before risking another dollar, complete 20 perfect trades in forward testing. Not profitable trades, but perfect execution trades. Track your psychology as closely as your P&L. Type forward 20 if you commit to this. Share what psychological pattern you most need to address. Early exits, move stops, revenge trading. Awareness plus practice equals progress. Remember, the market doesn't care about your backtest. It cares about your behavior. Forward testing trains behavior. Master this bridge between theory and reality, and profits will follow naturally. Chapter 8. Rituals, the hidden edge of consistency. Discipline isn't something you summon in the moment, a burst of willpower that magically appears when you need it most. True discipline, the kind that leads to consistent success in trading, is something you install through repetition. The best traders don't possess more willpower than you. They simply have better rituals. These rituals become psychological anchors, creating consistency even when everything else, the market, your emotions, external events, is chaos. Mark Douglas, in his seminal work Trading in the Zone, understood this deeply. He wrote about traders who succeed not primarily through superior analysis, but through routine. They create what he called states of mind through repeated actions. The ritual, over time, becomes the trigger for the right psychology, automatically shifting them into an optimal trading state. Let me show you what this looks like in practice through traders who have mastered the ritual game. Ross Cameron, the renowned Momo trader, starts every single session identically. I wake at 7 a.m., meditate for 10 minutes, review my rules out loud, then scan for gaps. He's followed this exact sequence for years. The routine tells my brain it's time to trade. By market open, I'm in the zone automatically. His results speak volumes, multiple seven-figure years, not from finding better setups, but from executing the same setups better through ritualized preparation. But rituals aren't just about morning routines. They're about creating behavioral triggers throughout your entire trading day. Consider the check-in ritual. Forex trader Anna FX posts her approach. Every 30 minutes, I do a state check, close my eyes, 3 deep breaths, ask, am I trading my plan or my emotions? This micro reset has saved her countless revenge trades. It's a conscious pause to realign. Then there's the entry ritual. A crypto scalper shared on Reddit. Before clicking buy, I say out loud what I see. Break of resistance, volume confirmation, risk $50 to make 150. Speaking it makes it real. Stops me from fantasy trades. This verbalization forces clarity and commitment. The exit ritual is equally crucial. Professional trader Mike Bellafiore from SMB Capital teaches this. When you hit your target, celebrate for exactly 10 seconds. Ring a bell, fist pump, whatever. Then immediately review what you did right. This positive reinforcement wires your brain to repeat success. And finally, the loss ritual. This one is perhaps the most vital. Tom Huggard has a specific routine after losses. I stand up, walk to my window, look outside for 60 seconds, no phone, no charts, just breathing. This physical break prevents emotional trading. The loss ends at the window. But here's what most people miss. Rituals aren't just actions. They are state changes. Each ritual should shift you from one psychological state to another. Your pre-market ritual shifts you from daily life to trader mode. Your entry ritual shifts you from analysis to execution. Your trade management ritual shifts you from hope to process. Your exit ritual shifts you from attachment to neutrality. Your post-trade ritual shifts you from outcome to learning. And your end-of-day ritual shifts you from trader back to person. The true power lies in the transition, not just the action itself. A fascinating study from a prop firm tracked traders who used consistent rituals versus those who didn't. The ritual group had 40% less variance in their results. Not necessarily better results, but significantly more consistent results. And in trading, consistency is profitability. Let's talk about the neuroscience. Rituals work because they activate what researchers call implementation intentions. Instead of deciding in the moment, a process that fails under stress, you pre-decide. The ritual is the decision. This moves behavior from the prefrontal cortex, which is easily overwhelmed, to the basal ganglia, which operates automatically like a habit. One trader explained it perfectly. I don't decide whether to follow my stop. My ritual decides. When price hits my stop level, I click out and start my loss ritual. There's no decision point. It's just what happens next. Creating effective rituals requires understanding your personal triggers and needs. Here's a framework. First, identify your problem moments. When do you break rules? What emotional states precede your mistakes? Which transitions are most difficult for you? Second, design rituals specifically for those moments. Keep them simple, 3 to 5 steps maximum. Make them physical. Movement helps reset your physiology. Include a verbal component. Speaking your intentions reinforces them. And ensure they end with a clear state change. For example, if you revenge trade after losses, create a loss recovery ritual. Close all charts. Write the loss amount in your journal. Do 20 push-ups. A physical reset that literally changes your biochemistry, flushing stress hormones. Read your Why I Trade statement. Set a 15-minute timer before the next trade is allowed. The physical activity isn't random. It resets your nervous system. Here's the critical implementation advice. Start with one ritual. Master it for 21 days before adding another. Trying to install 5 rituals at once ensures none will stick. A reader once asked which ritual matters most. The answer surprised him. The end-of-day ritual. Why? Because how you close one day determines how you open the next. Most traders shut their laptop in frustration or exhaustion, carrying that negative energy into tomorrow. Instead, try this closing ritual. Screenshot your trades. Visual record. Write one thing you did well. Reinforce positive. Write one thing to improve. Growth mindset. Physically close your laptop, signaling the end of the trading day. This simple act creates a clean break, allowing you to reset and approach the next day with a fresh, optimized mindset. Conclusion: the path to aligned trading. You've embarked on a journey not just into the mechanics of trading, but into the profound depths of your own psychology. We've peeled back the layers, revealing that true trading success isn't about chasing the perfect strategy, but about cultivating a system that profoundly fits your nervous system. It's about understanding that the real war is fought within, not against the market. We began by recognizing the pervasive problem of mismatch, how blindly adopting strategies not aligned with your innate psychological wiring leads to inevitable frustration and failure. We then delved into the critical process of profiling, urging you to build a mirror for yourself, to understand your tempo, energy flow, decision style, and emotional triggers. This self-knowledge is the bedrock upon which sustainable trading is built. From there, we explored the architecture of alignment, demonstrating how choosing the right market, time frame, and strategy style, not for their profit potential, but for their psychological resonance, can transform your trading experience from torture to flow. We examined entry logic as a cognitive interface, emphasizing the need for clarity and simplicity to minimize internal friction. We then shifted to the psychology of protection in risk management, advocating for an emotional maximum that makes trading boring and therefore profitable. The journey continued with the crucial concept of guardrails, external controls that protect you from your predictable weaknesses, acknowledging that willpower alone is insufficient against the market's relentless psychological assault. We then crossed the bridge to reality through forward testing, understanding that this isn't about proving your system works, but about proving you can work your system under pressure, training your nervous system for the real battle. Finally, we uncovered the hidden edge of consistency in rituals, pre-decided actions that shift your psychological state, making optimal behavior automatic rather than a constant struggle. So I encourage you to take these insights, apply them, and embark on your own journey of self-discovery and trading. The market awaits, ready to reward those who understand that the greatest edge lies not in what you trade, but in who you are and how well you align your system with your unique self. Your best trading self is waiting to be unleashed.